We'll go ahead and get started then. First of all, welcome everybody. This is Revisor's first manager spotlight call. For those of you who don't know, my name's Ethan Dunbar. I'm the Chief Investment Officer here at Revisor. And to start the call off today, I wanted to give a little context to what's going on with these manager spotlight calls that we're going to be having here in the end of 2025 and then leading into 2026. For those of you who have been with us for a long time, you'll know that Revisor, our investment research, our investment committee team has been the primary driver of the investment decision making, either directly or in conjunction with you and your investment teams in-house. Going into 2025 and then really leading into 2026, we wanted to expand the offering and include other managers on the platform to make it make it just easier for you all to get access to the different types of investments that you want to have access to. So the manager spotlight calls in 2025 here, Josh and Park City being our first guests here, going into 2026 will be calls where we highlight these different managers that we're making available to the Revisor platform, and we'll be available options for you all, every advisor on the Revisor platform. So with that context in place, I want to introduce our first manager in this series in Josh Flade and Park City Investment Solutions. So welcome, Josh. Welcome to the call.
Thank you so much. And this is so much fun for me for multiple reasons. One, because previously I was helped building a turnkey asset management platform in my last job. And then also just working closely with, Ethan, Landon, Nick, the team there on some of the investments is just been a lot of fun. Like all the advisors that are plugged into your system should be very grateful for like the expertise and the knowledge that you all have. So anyway,
Well, yeah, thank you, Josh. Appreciate the kind words. Very excited to have you on today. Would you mind giving us a brief personal background and professional background before we
yeah,
get into some of the discussion today?
yeah, for sure. So I started my career at Goldman, and then I was there as a credit research analyst. Went from Goldman to what's called Ensign Peak Advisors. That's the LDS churches or the Mormon churches endowment arm. They have a very large endowment. I was one of 20 investment professionals there, managing a pretty significant amount of money, which was so much fun. It was so much fun going from Goldman, having that institutional experience, and then going to Ensign Peak, having this other institutional investment experience. Then I wanted to scratch an entrepreneurial itch, and I left Ensign Peak to then join a firm in Provo, Utah called Town Square Capital. And I built out a fixed income SMA platform for them. Grew it from, whatever, we had about 50 million assets when I left. We had north of $1 billion across 6 different fixed income SMA strategies. Tanner, who's on this call right now, he's a senior investment specialist at Park City Investment Solutions. He was my first hire and helped me build that out. So that was a lot of fun. Transitioned to then deputy chief investment officer and functionally the chief investment officer at Town Square. And then we sold to Orion. If any of you use Orion's software, their tech solution. So then we sold to Orion. We had about 6.5 billion in assets at that time. So over 4 years, we grew from a few hundred million to 6.5 billion. And then in that post acquisition space, I was the deputy chief investment officer at Orion for 2 years and then left and then wanted to do something entrepreneurial again. So started where I'm helping build out a ultra high net worth practice called Park City Wealth Advisors with my business partner, Morgan. And then we also started a sister business, Park City Investment Solutions, that allows us to take everything that we're doing here for our clients and allow other financial advisors to plug in. And that has led us to this conversation with Revisor, which has been gracious enough to let us work with them and provide our models for financial advisors, which I feel like are very complementary to what has already been built out at Revisor.
Yes, yeah, absolutely. Your perspective always is an interesting one to me, Josh, because you've worked in such different capacities, both at advisory firms, at a TAMP that was then sold to a massive institution in Orion. It's just I always appreciate your perspective on the industry. And what is it about the new space that you're in now at Park City and the partnership with Revisor that's most exciting or most interesting to you?
Yeah. To me, it's probably the same thing that is exciting for you, Ethan, and everybody at Revisor, which is I just love helping people and helping advisors win money. Like there are few things that bring me more joy than that. And so that's that I think that that's awesome. And just helping advisors create better investments and better outcomes for their clients is really satisfying for me. And that's kind of what keeps it, what helps me kind of wake up in the morning is that opportunity.
Yeah, absolutely. Well, I feel, from our perspective, that's been a major point of a goal here at Revisor is to make sure that we're properly supporting the advisors and really truly partnering them instead of just providing this cookie cutter solutions. The flexibility needed to, come up with what's needed for the client to help you win the business is one of the most important things. So that was one of the most exciting things in the partnership with you all and with all the managers that we're bringing onto the platform here is they're all true partners instead of just some manager that you're never going to talk to the chief investment officer. You're never going to talk to the actual portfolio manager. You're going to talk to some wholesaler. And that's not what we want here. That's not what you are at Park City. And I really am excited for the partnership because it meshes very well with our DNA as a firm.
Yeah, absolutely. And I'll tease this right now, but the project that we've been working on in the background, this 10 themes over 10 years, I think all advisors would resonate with this. Every advisor is getting questions around crypto, around, around AI, around all, nuclear, like all of these things, these buzzwords, the quantum computing, like all these buzzwords that are out there that people want access to those investments and creating a model that encapsulates some of those things in this kind of 10 themes in 10 years that we've been working on, I think has been really fun and I think will be useful for advisors.
Yes, absolutely. I'm yeah, very excited about that. We'll get into that a little bit today at the end, but absolutely. And the other thing as we get into some conversation about the economy and markets, the other thing that I know you're available for, as well as the Revisor investment team, is to have market discussions and economic discussions. Where again, we're not, six layers away. The CIOs and the portfolio managers are not six, 7 layers away from the advisor and their clients. We want to have those discussions. We want to jump on the phone with you or have even, more intimate discussions about markets and have the discussions that we're having today with your input and with your conversation and questions as well. So again, we're not far away. We're always just a phone call away in these environments. So with that being said, getting into some markets and economy, you know, it's an interesting year. We were coming off of 2023, 2024, and then another great year in 2025. And, it's sometimes you feel like some of these valuations can't get stretched further, but now the top seven names in the S&P 500 are 30+% of the index. Valuation seems stretched to some degree, but those names are the ones providing earnings, right? How have you and your team at Park City thought of markets going through the last part of 2025 and into 2026?
Yeah. I yes, valuations do feel a little bit stretched. It doesn't mean though that you can't have a growth, right? Earnings growth into valuations. It also doesn't mean that you also can't have like just really strong earnings growth and valuations staying the same the next year, which would let's just like mathematically think about this. If valuations stay the same 12 months, but earnings are growing in low double digits, like then you would expect low double-digit returns in equity markets. So where could you potentially see like a weakness in equity markets? Yes, you could have multiples come down and you could still have very attractive earnings growth, and then you would have, kind of a flat market in that scenario. But yeah, I mean, valuations are a little bit stretched. I'm always in the camp of, you don't want to take more risk than you need to. And when you do have these very nice bull runs, I do think there's opportunities to rebalance and diversify. And so we'll talk a little bit about that because I think our models are built around that idea, is like how best can you diversify while still achieving some type of outcome that you're shooting for. But yeah, I'd like to sum it up. That's kind of my view. I mean, in fact, if you wouldn't mind, I'll share like these two slides, I think, point to this very idea, because I get this question a lot from advisors, just like, how is it that the markets have just held up so well this year despite all of the worries around the economy, worries around tariffs, all these things? And if there's one or two slides that point to why that is, it's this. It's expectation. This is expected earnings growth year over year for second quarter. You have the 493 stocks in the S&P 500, and then you have the Magnificent Seven. That was what was expected. This is what came in. So for
Right.
second quarter, and then you look at third quarter, and it's a very similar story. You had expectations around here, and then guess what actually came in? So we're starting to see expectations catch up with what the earnings growth has been in the Magnificent Seven, but you're still seeing a pretty massive gap between expectations and the rest of the S&P 500 and what's actually happening.
Yes, yeah, absolutely. The encouraging thing that I saw in earnings season this last quarter was there was a broadening out though. The rest of the 493 stocks in the index actually did all right. Actually had some growth, some signs of life that weren't there in the past because it's really been heavily heavily weighted towards those top seven names. And we actually see some performance from the other names and seen some broadening out in not just the earnings, but in the performance in this last quarter as well, which
Absolutely.
is a
Yeah,
good thing.
which is
Yeah,
it's
healthy.
encouraging. Yeah, breadth is very healthy, which leads to this idea of diversification, like not being so concentrated in the Magnificent Seven. If we do see kind of a little bit of softness in those names over the next 12 months, and breadth is definitely healthy for the markets.
Yes, absolutely. Well, and we were talking about this a little bit yesterday as well, Josh, but I feel like it's very easy to find what you want to support your thesis, right? So this is from advisors, from clients, whoever from portfolio managers, whoever the investor is. It's very easy to, get your thesis first and then find supporting documentation later. And we had a call this morning with a group that we were discussing this as well. And again, you can find scenarios or supporting evidence for a bullish case. You can find scenarios for a bearish case. You can find really anything you want out there, depending on how you spin the information that you're getting. And again, it lends to, at the end of the day, none of us, no matter how much experience we have, no matter what our position may be, we're all in this position where we don't actually know exactly what's going to happen. And it lends to this, well, that's a good reason why we diversify. We don't just own the S&P 500. We own dividend paying stocks. We own growth stocks. We own value stocks. We own large, mid, small cap stocks. We own international, everything. And even alternatives in the cases where it's appropriate for clients. So I think that sometimes gets lost, especially by clients. And you can feel the questions coming from clients when they're just, I don't know, this last year is a perfect example, just piling into NVIDIA every single chance they got. Not, I mean, wonderful company, right? Phenomenal earnings. Where can you find the earnings growth that NVIDIA has delivered? But it's very easy to get distracted and lose your diversification in cases like this.
Do you mind if I share a few of these slides I think are interesting?
Yeah,
This is the
please do.
fun part about what I get to do because I straddle the two businesses, the Park City Wealth Advisors, which is really focused on ultra high net worth. I'm in meetings with these ultra not high worth individuals and hearing them talk about their concerns. And this is a very common concern. And it makes sense because look at what the media is constantly selling. They're selling fear. They're selling recession worries, like all of these things, right? 5 clear signs the US is likely heading into recession next year. This is from September 16th. So it's like this is what your clients are seeing, but then this is the reality, and this is what I really like to lean on education and data with advisors, because then they can lean on education and data with their clients. And if you look, this is data coming out of the Atlanta Fed. Everybody has access to this data. Just Google GDP now. You have the same access to this as I do. This is third quarter. So because of all the government shutdowns and the delays, we have a delay on some of this data. But this is what's looking at third quarter. This blue line is what blue chip economists are expecting for GDP growth annualized in third quarter. The green line is what the Atlanta Fed's leading economic indicators are showing. And I mean, we're seeing almost a 4% expectation on those leading economic indicators, which are actually super accurate. If you go 1 month forward after the end of the last quarter, this becomes really accurate. So the reality is this GDP growth in third quarter is likely to come in, high 3%. So that's the actual data, right? And then you look at some of these other data points, and I know you and I, Ethan, were talking about this, and any advisor who has been traveling in the last 2 months, like you have seen this firsthand. This is USTS, the US TSA checkpoints. The gray line is 2024, which was a record year for travel. 2025's this dark red line is right on top of that. So what is this data telling me? It tells me that people are out there traveling and they're spending money, and that's supported by here's some more data. This is weekly retail sales year over year growth. And if you just take this snapshot right here and you compare that snapshot to this snapshot, what does it tell you? It's almost identical. It tells you that like people are out there spending money like they were spending money pre-COVID. And so we're in a normalized environment, and we're not seeing a lot of softness in some of this data. Where we are maybe seeing a little bit of softness, and I know Ethan, you and I have talked about this, is around the employment picture, and we are seeing a little bit of unemployment sneaking up. But if you look at initial jobless claims, so this data comes out every Thursday as long as the government's operating. This weekly data point between 200,000 and kind of 250,000 is very normal. If I showed you a chart pre-COVID of 2019, that this is exactly what we would be seeing. Now, where we've seen a little bit of softness is in this weekly data that comes out, the continued claims. You can see that we've drifted up from 1.8 million towards the end of 2023 up to a little bit closer to 1.9 to 2 million. So we have seen some softness, which correlates with the unemployment data, but we're not seeing like material softness there. So the economy is clearly going through a transition. The employment environment is clearly going through a transition. But if there's any kind of softness in some of the economic data, it's probably around that.
Right. Well, that makes sense. Absolutely. Well, thanks for sharing that stuff. And so with that being said, how have you're transitioning a bit into your investments and your investment philosophy? We talked a little bit about diversification. We talked about, relying on data. When you get into your philosophy, how do you then apply that to the investment decisions that you make?
Yeah. And this is what we like to share with clients, and we like to educate advisors on. And there's so many investment philosophies out there, and this is evergreen in nature, meaning like this is it's kind of like the Constitution, like it's a living document. Like you will make amendments to this, but what we really try to find are timeless principles that resonate with end clients is what we're looking for. And so some of the things that we find that are helpful that resonates with clients are these, knowing what you own and why you own it. I don't know how many times I've helped a financial advisor win business by just asking the prospect, hey, walk me through what you own and why you own it. And invariably they're like, I actually don't know. And then that tells me that like their financial advisor is doing something wrong. Their financial advisor should be educating them, should be helping them understand what they own and why they own it. There's always a reason not to invest. There's always a reason. In fact, you know what? Instead of going through this, I'm going to actually go through. This is a great quote for those who are fans of Peter Lynch. You know, obviously, like a amazing investor with an incredible track record back in the day. And I always love turning back to those incredible investors of history to learn as much as I can. But this chart I think really speaks to that. Always a reason not to invest. And I love sharing this chart with clients because if you look at $1 invested in the S&P 500 back in 1989, and you look and you can see how that has grown to about $38 over this time frame. Now, every single one of these red words is a reason why you shouldn't invest in the markets, right? And obviously, right, this path is volatile. So, but the worst decision you can make, as long as you have a long enough time horizon, is to not invest. So, despite all of these, many reasons not to invest, the worst decision you can make is not invest. And so, that's we really like to educate clients on that. The other thing that we firmly believe in is just nobody can really time the market. And the reality is, and I've seen this happen so many times. I've talked to so many financial advisors and individuals who are like, "Hey, I sold out, and I sold out right before COVID, or I sold out." And invariably, I always ask, "Well, when did you buy back in?" And I was talking to a friend of mine who was helping some financial advisors in Texas. This group, they sold in 20, let's see, they sold in January of 2022. They sold completely out of equities. And this person, my friend, was working with them and asked, well, and this is 2024. It was like, okay, well, like, when did you buy back in? They never bought back in. And it's because that you can maybe get one kind of one thing right, but it doesn't. Whenever you're investing and you're trying to time the markets, it's like a decision tree. So, okay, yes, you got this decision right, but you need to make another decision. Then you need to make another decision. You have to make another decision. The probability of getting all those decisions right is very low. So we like to stay invested for the long run. We always talk about investing through cycles and trying to be thoughtful in asset allocation, but not trying to time the market and go into cash. And here's some data that supports that is if you look at the 50 best days in the markets, 50% of the best days actually happen during bear markets. So so you're missing out on these big opportunities that do happen during bear markets. And if you just missed 10 of the best days over this time horizon, this is from 1994 to 2023, your performance is cut in half. So, and I've seen this multiple times, right? Oh, I sold out. I timed it right. The market's down a bunch to, today or tomorrow, but then they miss out on like the 10% rally in April 8th, right? Like that is invariably going to happen. And so it's very hard to get to be right twice. Avoid unnecessary costs. I love this chart here. If anybody knows Poland, large cap growth manager, you can access them two different ways: their SMA and their mutual fund. SMA, roughly whatever, 65 basis points. Their mutual fund's 125 basis points. You would think that the difference in your performance between the two would just be the fees, which is just 60 basis points. But you look, and the actual difference between the SMA and the mutual fund is actually, in 1 year, 1.8%, but over the long run, it's closer to kind of 1.6%. So the question is where is the missing 1%? If the mutual fund's underperforming by 1.6%, you would expect it to be, the 60 basis points is because of the fee difference, the higher fees in the mutual fund. But the reality is mutual funds can have a lot of hidden costs. And so choosing the right vehicle, avoiding unnecessary costs is very important to us. And this last one, with a zero interest rate environment post the great financial crisis, you had an environment where companies were able to borrow at close to zero interest rates and extend their lives when they probably should have gone under. And so we're trying. What do we try to do? We try to avoid zombie companies, companies that are not growing, companies that are not generating, are very profitable, that can cover their debt payments, all of those things. And you can see here that those types of companies that are not generating enough income to cover their debt has skyrocketed in this kind of post-great financial crisis world.
Right. Absolutely. Quality is just such quality works in all environments, in my opinion. Obviously, there are
Yep.
times in which junky companies can do very well, but at the end of the day, owning quality is never going to hurt you. And that's just
Yeah.
such a good point to make there. I
No,
really like that.
especially over the long run, right? I mean, here's some data around that. Quality's outperformed growth value, U.S. equities over the long run. Like not only that, but it's, you look at this annualized volatility and then you look at returns and you can see how quality, gets you better returns, but still keeps volatility relatively low. So that anyway, I think there's some real arguments for being a good quality long-term investor.
Yes, absolutely. Absolutely. And I really love what you said about you know, not timing the market, it's time in the market. That's such a COVID was such a good example of this. The number of clients that were just completely losing it, can't believe that they think the world's ending, right? And then all of a sudden you see this snapback that we're back to where we were before the end of the year. And it's just, there's so many clients, especially retail investors. That's where I think, a lot of business can be won on those retail clients that have been doing it themselves for a long period of time. When they inevitably make emotional mistakes like that, that's one of the things that I think as advisors we can step in and help so much in periods of volatility is make sure people are diversified properly and make sure you're handling the decision making like that it's time in the market, not timing the market. I think that's what a lot of retail investors or investors that have started working with a financial advisor, maybe haven't worked with one in the past, are asking you to do. But retraining and educating on that type of data for those type of investors is so important.
Yeah,
It's a
I
good way
al-
to.
I like to remind advisors that it's during periods of volatility that you earn your fees. It's
Yeah.
during those stressful periods that you hold your client's hand and you say it's going to be okay because it always ends up being okay. Even the great financial crisis, right? Like if you're well diversified, you have a thoughtful asset allocation, you have a game plan, yes, it's going to be painful, but it is going to be okay. And that's how I think you earn your fees. You can earn a lifetime of fees in one volatile market.
Yes, absolutely.
Do you mind if I touch on these on alternatives, just because that's a core part of kind of what we do within most of our models? This
Yeah,
is
yeah, please do, and give us some insight into, I know we're not going to walk through every single portfolio that's
yeah,
available today, but give
yeah,
us some insight into, actual application in the portfolios you offer
yeah,
at Park
yeah.
City.
Love to. And then in fact, maybe we'll end in like 5 minutes, then we can do Q&A. But I think this is a very important subject because like this is what I was taught, right? I went to college, I studied finance. I was taught, okay, you start with the 60/40, you want more risk, you add more equity, you want less risk, you add more fixed income. And that was the approach. Now, the reality is having worked at Goldman, having worked at Ensign Peak, institutions do it differently, right? And to one degree, it makes sense because institutions are managing money forever. But you can see how Harvard manages money. Right? They've got 11.5% in emerging markets. Why is that? I feel like they feel like there's alpha to be generated. There's more alpha to be generated in emerging markets. But you look at foreign equities, you look at domestic equities. They've got 30% allocated to equities. Like this is like very fascinating. And where are they trying to generate alpha outside of that? Private equity, real estate. They've got some diversification with the absolute return bucket, natural resources, trying to generate alpha there. But that like they obviously are doing it a different way. I don't think that we need to copy Harvard. In fact, I would highly recommend that you don't copy Harvard. But it's clear that institutions invest differently. And why does that matter? I've got two slides. You take a 60/40 traditional portfolio, you take away 10% from the equities and 10% from the bonds, you introduce alternatives. And history has shown that you can decrease volatility and you can increase the annualized return, is what it's shown. Now, it's not during all periods, but over the long run, I do believe that. And that to me is the holy grail of investing. If you can decrease volatility and increase expected returns, that literally is the holy grail. Um, and this is like one simple example of that is private credit. I know private credit's been in the news for those who have been following it. It's been in the news a lot. I think it's overblown. Like, I don't think private credit is going to cause the next great financial crisis. I don't think there's massive cracks in private credit. I think you have to really do your due diligence. But this is one private lending fund in the private credit landscape. Look at its performance starting in late 2019 when it launched, compared to liquid loans, T-bills, or investment grade bonds. This is total performance. I mean, if you investment grade bonds 8% versus 78%, like if you had just allocated 10% of your portfolio to some type of private credit allocation and taken some money away from bonds, I mean, you would have completely smashed relative performance. So that's why I think that it's so important to have an open mind to other types of investments that are out there and start incorporating more of those institutional type investments into portfolios.
Yes, absolutely. Very, very much so. Thank you for sharing that Josh. So with alternatives specifically in your portfolios, you brought up one fund that's an option for you in your portfolios. What other types of private investments or alternative investments have you included in your portfolios, and how have you done that?
Yeah, so like private equity is a major player on some of, and real quick, I'll go through these. So the portfolios we're managing, we've got a growth SMA, 40 individual stocks, and some SMID exposure through ETF. So that's kind of a core allocation that you can allocate to that has a quality growth tilt. We have a growth ETF, which tries to replicate the same exposure, but with a lower minimum using ETFs. And then we have this growth alt plus. This is getting to your question, which is, hey, like, how are you implementing alternatives and what alternatives you have exposure to? I'll go down to that growth alt plus. And it starts with just looking at what's out there, like looking at interval funds. These are semi-liquid funds. They're daily liquid in, quarterly liquid out. And then what I've done here is I've allocated kind of this core piece to private equity using two of these managers, which are very complementary in their nature. And then I build around that kind of growth your core piece with some private credit, some catastrophe bonds for a little bit of liquidity and diversification, CLO equities, which have historically had equity-like returns over the long run, but are a little bit more counter-cyclical in their performance, and then infrastructure, which just adds a little bit of defensiveness. But these are all co-invests that they're underwriting in the low to mid-teens. So through cycles, I would expect equity-like returns, but diversified equity-like returns. And then all real quick, then on this side, and the way I think about this is this like three themes: growth, income, and protection. And then those three themes match the way that we're building portfolios. And you've got defensive income, 75% investment grade corporate bond exposure plus some private credit. You've got income, which is high yield, 75% allocation to high yield or non-investment grade exposure, plus private credit. So this is really targeting kind of mid single digit returns. This is targeting high single digit returns. And then the income alt plus is utilizing alternatives in the kind of income oriented alternatives, and really is targeting kind of high single digit to low double digit returns. And then this protection piece is really kind of mid to low single digit returns, really trying to just beat money market accounts for the most part.
Yeah.
And on that income alt plus, I'll be real quick here. It's the same idea. I start with this core 50% allocation to traditional private credit, broad private credit, and then private lending to lower middle market companies. And then I enhance that and diversify using a little bit more infrastructure, some catastrophe bonds, some CLO equity and CLO debt. And kind of the combination of all that is getting that high single digit yield right now. I know there's a ton to unpack there, so apologies. I feel like I could go on for an hour about all these different pieces, but hopefully that at least paints a picture of what we're trying to achieve as far as kind of target long-term returns and then income expectations.
Yes, absolutely. Well, and for today's call, we wanted to highlight the overview of everything. And for those who are interested, we'll be happy to make direct introductions to Josh and Park City and their team and let you guys hash out the questions in more detailed, in a more intimate format whenever necessary. All of these are already available through any of the accounts that we manage that we have access to for our advisors. So they're very easy to plug in, and it's just about understanding them. And Josh and his team are wonderful when we have questions that come up and you want to get more detailed answers than what we're able to cover today on the call. And
The
go ahead, Josh. Sorry.
Oh no, I was going to say for those interested, I do have a slide on this. It's kind of this is not exactly how it came out to be, so apologies that this is not the exact 10 themes, but at least gives you an idea of some of the things that we were thinking about. But this is the project that we were working on with Ethan and Nick. Is how can we potentially allocate 5 to 10% of people's portfolios to something that we think has like long-term secular trends behind it, and it that is also somewhat evergreen in nature, right? Like we can have a trend here that maybe is falls out of favor, and so we may end up like selling that trend and then adding a different trend. But these are just some of the things that we talked about as a team, and so super excited for that strategy to launch. So anyway, I think a great way to for those clients that are saying, "Hey, I really want exposure to nuclear. I really want exposure to this," to do it in a thoughtful way, in a diversified way. This is one way that advisors could consider that.
Yes, absolutely. And one of the key things in all of these strategies is the way the platform is designed. We're able to mix and match all of these things with existing monies, inherited monies, new strategies that you discover. The beauty of the platform here is that we're able to mix and match to create what's needed for the client. Again, going back to some of the discussion at the beginning of this call, where we're talking about the desire to be able to help advisors win business, to be able to customize portfolios for clients. We're able to do that with that satellite sleeve that Josh was just talking about, all the Park City strategies, all the Revisor strategies, and all the coming managers. That's the beauty of all of this, is it's available to be customized for that client and done at scale, so that we can help get what clients need in their accounts.
Yeah, I like kind of like you can do this in kind of like so many different ways, right? Like a core satellite approach where you can say, hey, like I'm going to keep, I'm going to have more traditional asset allocation with some of the revisor models, and then bolt on, oh, like your income alt plus, Josh. Like I really like that. I like the thoughtfulness and the income generated off of that, and I understand the illiquidity risk. Then it's like, okay, well, wait, I can take 5 or 10% of my portfolio and allocate to that. And I think that those types of little changes can enhance expected returns and also enhance just the general income that people are getting.
Yes, absolutely. And it helps things match better to what clients actually need and want. The cookie cutter portfolios are so easy, right? You have 10 portfolios and you're either 60/40 or 70/30, and that's it, right? But the ability to customize actually gives you the ability to plug in components of a portfolio that might be needed to match what that client wants. Whether they want to be more aggressive or more conservative, it doesn't really matter, but your cookie cutter portfolios don't provide that. And the ability to mix in, like you mentioned, Josh, the core satellite approach, where you can have the core of the portfolio that may be, something you use over and over and over again, but on certain clients, you're going to blend in something else. And when you can do that at scale, it makes it really easy to get exactly what the client wants and needs.
Do you mind if I just share these two slides, just because I think these are like very intellectually interesting?
Yes,
Uh,
please.
this is data out of JP Morgan, and they've gone back over the last 40 years and looked at how equity markets, the S&P 500, has performed after the Fed makes a first cut. And there's two paths that are very clearly laid out here, which is if the markets or the economy goes into a recession, markets will really underperform after that first cut. But if markets don't go into a recession, markets tend to perform pretty well. And I think that, looking at the leading economic indicators that we look at, like I don't think we're going in a recession in the next 12 months. You look at what the Fed is doing, cutting interest rates, and they're going to cut in December, at least if you believe kind of the probabilities that we're seeing right now, and at least like the Fed's been pretty good about leaking to the Wall Street Journal a couple weeks before what they're going to do, and I don't think that that's changed necessarily. So I think there's a pretty high likelihood of a Fed cut, and then a path for more Fed cuts next year, on top of a government that is addicted to spending. I don't care whether you're a Democrat or Republican; both parties are addicted to spending. That's not going to change this next year. And you've got the one big beautiful bill. Like all of those stimulative effects are going to come in around April of next year. So you have massive government spending, you have interest rates going lower. It is shaping up for a relatively good background for the economy. And so I don't think that we're going to have a recession next year. This is also something thematically we're really looking at is just commercial real estate, U.S. core commercial real estate. We're talking uh, multifamily, we're talking industrial buildings. It does include office in there, although like I would still be a little bit skeptical on and careful and treading in office space. But shopping centers, triple net leases, there's a lot of pieces in U.S. core commercial real estate. But if you look back historically, there is these big bull markets, right? 10-year long bull markets that are very consistent. And then you have these periods of softness where you have sell-offs. We've clearly been in one of those sell-off periods. I think things are shaping up to have the next kind of 10-year bull run in commercial real estate. And so this is a big theme that we're doing due diligence on. Like, what's the right vehicle? What's the right exposure? What's the best risk adjusted return potential for our clients? So this is something that we are starting to weave into some of the income alt plus and the growth alt plus portfolios, and potentially going to weave into the income and defensive income as well.
Okay, awesome. Well, we will, for future spotlight calls, we're certainly going to have you back, Josh. So we may be able to focus on some of that research that you're doing in 2026 when we do some more of these calls in the future. So excited to hear more about that.
Awesome. Yeah, no, thank you so much. It's always a pleasure working with you guys.
Yeah, absolutely. But the pleasure is ours. And again, just as a reminder, everybody, these are launching now. This is our first, spotlight call, but we're going to have more in 2026. And the Park City strategies, anybody who's interested in learning more about them, we're happy to connect you directly with Josh and his team so that you can ask more, more pointed questions than we were able to cover today. But with that being said, we do have about 10 or 15 minutes left. So if anybody does have questions for Josh and team or anybody at Revisor, please feel free to unmute yourself and ask away. And again, we'll have the recording up after this as well. But if nobody has, does anybody have questions?
Any more color on where you see most opportunity right now, Josh? I know you're looking long term, and I use those bucket analogies to allocate dollars, but just from a pure tactical approach, is there anything that looks really intriguing with, the recent pullback in markets?
Yeah, yes. Do you want me to say Bitcoin, Griffin? No, I'm just kidding. Griffin
I
and I
wanted to hear it.
are like
I wanted to hear it out of your
personal
mouth.
friends. So I'll give that shout out. Griffin's always pushing me to buy Bitcoin, which I will, I promise. No, I mean I do. Yes, I think some of those themes that have ran a little bit hot earlier this year have had a little bit of a sell off. But I do think like if you have had clients that have expressed interest in Bitcoin or cryptocurrencies and blockchain and all of those things, like I think now's not a bad time to be allocating, even just on
Yeah.
the margin. I think that like I know I mentioned commercial real estate. I think there are some very unique opportunities in commercial real estate right now. And so we're kicking the tires on a fund that is 70% equity exposure, direct equity exposure to commercial real estate, multifamily, industrial, triple net lease is the majority of the portfolio. It's kicking, and then 30% is direct debt exposure to backed by commercial real estate. It's kicking off close to a 7% income that's tax advantaged because of the depreciation on the equity part of the commercial real estate. So like a tax equivalent yield on a 7% income play is like for somebody in the highest tax bracket, that's like getting low teens. in traditional fixed income markets. So you start with a 7% tax efficient yield. On top of that, they're structurally the group that's behind this investment is they have received shares in the investment as compensation. They're taking their $200 million of shares and they're putting that up to be retired if this stock price is not more than $27 by June 1st of 2027. So we're looking at an 18-month time frame. The stock price is it's about 15% below that $27 price. So you're looking at a potential 10% in income that's tax advantaged, and you're looking at a potential 15% in stock appreciation, artificially driven, right? Like does not matter what the underlying investments do. You have like a very nice 15% buffer there. And I just think that that's like a very attractive 25% like potential return over 18-month time frame that I think it offers a very attractive risk adjusted return. So that's like one example of like something we're doing due diligence on that we are looking at adding to the portfolios.
Yep, love it. And then like when people are or even the news are talking about, like a bubble in the AI market, to me it seems like what had been bubbly has popped, like quantum computing stocks, for example, like Rigetti is down 50% from the highs, and a lot of the downstream AI companies um, are down significantly. It doesn't seem like some of the big players like Google and Nvidia are overvalued, especially with the earnings growth that they have. It seems like they're fairly valued. Would you answer that to a client that's asking about a bubble, like that things are looking healthy, and the overvalued companies have already kind of seen their, bubble pop? I mean, that's just the way I look at it, but I'm just curious.
No, I think it's like a very fair assessment of the situation, which is not surprising because it's kind of like that old adage that markets are it's a voting machine in the short term and it's a weighing machine in the long term. And so like you see people use money to vote and they get excited about certain themes, but if you don't have earnings to support those valuations, then ultimately the voting machine turns into that weighing machine where then those stocks end up getting weighed and they are found wanting sometimes. It doesn't mean that there's still not tons of potential in some of those stocks, but I think maybe valuations got a little bit ahead of themselves. So not
Yeah.
like potentially, right? Not a bad time to allocate to some of those that like those 10 themes that I was talking about, right? Quantum computing, like it is
Yeah.
clear that quantum computing is going to change our lives. Like it is clear that AI is going to change our lives, and we are in the first innings of that. And it's clear
Yeah.
that robotics is going to change our lives. Like there's so many different things that like I think that in like let's just take cars because that's like very easy to understand and relate to. Like I think in my grandchildren are going to look back and they're going to look at me and say, you are a heathen. Like you are like the fact that you guys like drove cars and allowed 50,000 people to die a year in the United States in car related accidents is
Yeah.
just like you guys are monsters.
Yeah.
And
Yeah.
because guess what? In 30, 40 years, there will probably be zero car accidents a year. Like that is the future that is likely going to happen because you're
Yeah.
going to have cars that are going to be self-driving and they're going to communicate with each other, and you're going to have an environment where you don't have to have insurance, or insurance is so cheap. Like you're paying a fraction on insurance of what you're paying. You're paying 1% of the insurance that you're paying right now. And
Yep.
those are the things that will come with these technological advancements. But
Yeah.
it's going to take time. It's going to take regulatory changes. It's going to take, it's going to take change. But that's like the reality that is going to like our grandchildren will have, I think.
Yeah. Totally. One more question if no one else has one. Anybody else want to speak up? I didn't realize my video wasn't on.
Here. I think
Um,
we got a question in the chat from Brad.
yeah, take it.
Brad said, are you able to 1031 into the portfolio? Brad, are you still
No, no. And maybe we'll have to add. Oh no, I do see Brad on here. No, there's not. No, there's not 1031s in that particular investment. No.
Okay. Just comes up from time to time, and it's hard to find those options. So
Yeah, yeah. And happy to connect with you, Brad, and connect you with some of the 1031 groups that we work with if you're looking for more options.
okay, sounds good. I appreciate it.
Yeah, there's some really good ones. Like we worked with a group, Net Lease Capital, to do some cash out exchanges. So basically, like you 1031 in, and you end up getting 87% or roughly 87% of your money that you put in back in a tax free. It's tax free that year. There are some lingering phantom tax stuff that you'll have to pay over the next, however long. But if you have somebody that has a very large portfolio or has a very large investment in real estate that they want to diversify, this is a fantastic tool to diversify.
Yep. I just want you to take on one more thing, Josh. Like healthcare, the last year to date's up 12. Over the last 12 months, rolling period, it's up 5, and then over the last 3 years, it's only up 11. It seems like AI, like if there's one place that's going to be significantly disruptive is in like biotech and healthcare, medical devices. Do you see that as like a good sector to start allocating maybe more than just the market weight?
Yeah, no, I do. I think it's ripe for disintermediation, and you're
Yes.
it's just like anything, you're going to have winners and losers. So it's just selecting management teams that you think, one, like the select management teams that are leaning into AI and are going to outperform management teams that are not. And
Yeah.
then two, I think like still like looking for that quality, right? Like companies that have good like defensive moats. And then on top of that, if you lean into AI for efficiencies, I think the potential is definitely massive.
Yeah. Cool. Thanks, dude.
Yeah, it's fun seeing. I mean, I've known Griffin and Teddy for a while, so it's nice to see you guys on here.
Yeah, likewise, man. Thanks for putting this together, Ethan.
Yeah, absolutely.
Thank
Thank
you,
you.
Josh. Thanks, Ethan.
Yes.
Yeah, no, thank you.
Thank you all.
Have a good day, everybody.
Yep.
Well,
Thank you,
thank
everybody.
you. Thanks, everybody. Have a good one.